Historically, bonds have provided solid total returns over time. Total return is the combination of income and capital appreciation. As you can see, an investment in bonds represented by the Barclays Capital Aggregate Bond Index produced a cumulative total return of more than 1,000% over the last 30 years. So even though traditionally investors have bought stocks for growth and bonds for income, this generalization minimizes the total return potential of bonds. Of course, it is important to remember that this is a long-term view, and past performance does not guarantee future results. Yet even while the recent market volatility has been bad, bonds have held up well. The domestic version of this Barclays index returned 5.24% in 2008. How many people would like to have had that return in their portfolio's core holding? Another benefit of bonds is their ability to reduce a portfolio's downside risks. Take a look at this chart, which shows the best and worst rolling 12-month returns over the last 32 years for stocks and bonds. The left-hand side shows the worst periods for stocks and bonds, and the right-hand side shows the best periods for stocks and bonds. So on the left, the worst rolling 12-month return for bonds over the last 30-plus years was negative 9.2%, versus negative 38.09% for stocks. That's a difference of almost 30 percentage points. On the right is the upside. Stocks have outperformed bonds by about 25 percentage points. That is what you would expect out of stocks, because you buy them for growth potential. Then again, bonds have not done too badly either. So what this chart means is that while bonds can lose money during their worst periods, they can have a stabilizing effect on your portfolio. It is one of the reasons why bonds may be a great stepping stone as you decide what to do with your overinvestment in cash. We have talked about benefits, but where there are benefits, there also tend to be risks. And understanding risk can help you make better choices. This is particularly important today in light of the continuing market crisis. So let us take a look at some of the risks that are specific to the bond market. Interest rate risk. Interest rates and bond prices have an inverse relationship. When interest rates rise, as many experts expect will happen in the next few years, bond prices fall. And the longer a bond's lifespan, the more likely it will be subject to interest rate fluctuations. So if you think about what is happening today, interest rates can't get any lower. Do you think you want to lock in these low rates with long-term bonds? Or do you want to stay with the shorter duration bonds to reduce your interest rate risk? Credit risk. This deals with the potential that a bond issuer will fail to pay income or principal, or that the issuer's credit rating will decline, lowering the value of the issuer's bonds. Credit risk is especially relevant with investment-grade corporate bonds or lower-quality, high-yield corporates. The lower the quality, the greater the credit risk. Today, some experts believe the risk of corporate defaults will be trending upward, which makes it important to seek out higher-quality issues when looking at corporate bonds. Inflation risk. Like interest rate risk, inflation risk is expected to become more critical in coming years, as a result of the ever-expanding government balance sheets, as they spend more money to get us out of this financial crisis. Inflation risk is the risk that rising prices will erode the returns of a bond investment and reduce its purchasing power over time. Example: because of the effect of inflation, $1 in 1975 would be worth only 25 cents in 2009. So whether you are buying a bond or a loaf of bread, your money will generally buy less tomorrow than it does today. Prepayment risk. This is the risk that securities will be paid off before maturity, which can force investors to reinvest the proceeds at lower rates. Prepayment risk is usually associated with mortgage securities and is higher during periods of falling interest rates, when homeowners are motivated to refinance their mortgages. Example: today the Fed is helping to lower mortgage rates across the board, so a refinancing boom should cause prepayments to rise. This means holders of mortgage securities will get paid back early, but will then need to find somewhere else to invest their money, probably at today's lower rates unless they find timely opportunities. Market risk. This is the risk that related or unrelated market factors will cause bond prices to rise or fall, sometimes rapidly or unpredictably. Example: market risk is on people's minds today in the form of too-big-to-fail commercial banks. The market risk here relates to the belief that allowing these banks to fail would have a contagious effect on other fixed income securities. So let us recap what we have learned so far. Too many of us have too much sitting in cash, and bonds can play an important long-term role in your portfolio. So let us assume that you think you are interested in investing in bonds. The next decision is where to invest your excess allocation to cash, and how much of it to invest. So just as there are many classes of stocks, there are many classes of bonds to consider utilizing in your portfolio. Of course, broad diversification can be a helpful strategy, especially for risk-averse investors. So let us talk about specific bond strategies for putting your cash to work. Here you see 3 strategies for putting your cash to work. Remember that just as a well-diversified portfolio utilizes a range of asset classes, you may have a range of needs that put you in more than one category. Strategy 1. Step in. What we are talking about here is your near cash. This is the money that you want to keep relatively liquid, but do not need for regular expenses like bills or mortgage payments. Using this strategy lets you increase your return potential compared with your low cash returns, in exchange for taking a step further out on the risk spectrum. This strategy uses a vehicle called short-term bonds, which we will learn more about in a moment. Strategy 2. Step up. This strategy is about better positioning your portfolio for the long-term economic recovery by establishing a core position with a core bond investment. This strategy should not use money that you need in the short run, since it is not as liquid as cash or short-term bonds, but it is a good way to ease back into the markets with investable cash using bonds. Strategy 3. Step out. Our third and final strategy enables you to use a portion of your excess cash to focus on sectors that may benefit from economic stimulus plans and current market conditions. This strategy should include money that you will not necessarily use in the next couple of years, but remember that it is timely, so we will take a close look at the opportunities that are out there today. Now let us take a closer look at these strategies. Our first strategy, Step 1, is all about stepping into the markets using some of your excess cash. This strategy can help you preserve some liquidity, increase return potential in exchange for a small increase in risk, maintain some stability with a high-quality focus, seek broader bond market exposure, and a good vehicle for implementing this strategy is short-term bonds. Short-term bonds can play a valuable role in a portfolio. They generally offer a great deal of stability with returns that are typically higher than those of cash securities, albeit with additional risks, and high-quality exposure to a range of bond market sectors. Of course, short-term bonds do not guarantee investors the return of their principal the way that bank deposits do. And unlike money markets, they do not assure investors of an unwavering $1 share price, so they are not intended as a substitute for these securities within a strategic cash allocation. Yet short-term bonds do offer greater return potential for investors who want a conservative investment and can accept less than perfect stability. This greater return potential helps you fight lower cash returns, inflation, and taxes. Our second strategy, Step 2, is about stepping up your return potential even more by taking on moderate additional risk. This strategy allows you to utilize excess cash that is not needed within the next year. Take on moderate additional risk for a greater increase in return potential. Improve overall portfolio diversification with high-quality holdings. Position your portfolio to participate in the long-term economic recovery. And a good vehicle for implementing this strategy is a core bond holding. By that I mean an actively managed bond investment that is properly diversified and not overly concentrated in one sector, offers disciplined risk management processes, has stuck to its mandate throughout the market's many ups and downs, prudently takes advantage of attractive valuations in the market. So core bond investments can offer you greater return potential than cash and short-term bonds, in exchange for you accepting greater risk. When thinking about risk, however, keep in mind that the primary risk of over-investing in cash today is not having enough growth potential to meet long-term goals. That is why a core bond investment could be a good option for you. They put your portfolio in a better position today and tomorrow.